Imagine waking up tomorrow to check your phone. The government has just deposited 10 lakh rupees directly into your bank account. No strings attached, no loan to repay. At first glance, this solves everything. You could clear your debts instantly, you could put a down payment on a house, buy a new car, or finally afford better education for your children. Millions of people would suddenly feel rich. But we have to ask a logistical question. If everyone suddenly has 10 extra lakhs to spend, where exactly did all the new houses, cars, and schools come from? A government possesses the digital authority to add zeros to a bank ledger instantly, but it lacks the physical ability to conjure steel, cement, wheat, or medical degrees out of thin air. To understand why this creates a problem, we need to separate two concepts. Money is simply an accounting tool. It's designed to make the exchange of goods easier, but the paper itself holds no intrinsic value. Real wealth is the physical reality. It is the tangible goods, the actual services, the raw materials, and the skilled labor that an economy produces. Pumping more currency notes into a nation does not make it richer. True prosperity only occurs when a country expands its physical and intellectual capacity to produce useful things. In this highly simplified economy, a baseline money supply of 1,000 rupees balances against an output of 100 coconuts. Now, watch what happens if we multiply that money supply by 10. The currency expands drastically, but the coconuts remain completely stagnant. The island didn't grow a single extra coconut. Because the physical supply hasn't changed, the excess currency simply forces buyers into a bidding war. They have more cash, but they are fighting over the exact same limited resources. Bring that logic back to our 10 lakh thought experiment. When millions of citizens rush out to spend their sudden wealth, they quickly hit the real-world operational limits of businesses. You cannot build factories overnight. Agriculture is bound by seasons. Infrastructure takes time to expand. This flowchart visualizes exactly how inflation is triggered under these conditions. An influx of new money creates a massive spike in demand. When that demand slams into the rigid barrier of limited physical production, the inevitable result is intense upward pressure on prices. Businesses have no choice but to charge more. So that 10 lakh in your bank account starts buying you less and less. Unchecked demand hitting physical supply limits systematically erodes your purchasing power. If printing too much currency risks eroding purchasing power, you might wonder why monetary authorities ever choose to actively expand the money supply at all. The answer lies in the opposite economic danger. If consumers suddenly halt their spending, businesses stop investing, and factories cut production. That leads to a deflationary spiral where unemployment spikes and the entire economy weakens. To prevent the system from freezing, institutions like the Reserve Bank of India intervene. They manipulate interest rates to make borrowing cheaper, ensuring that credit keeps flowing even during periods of economic weakness. It is a constant, delicate balancing act. Effective monetary policy is about managing credit conditions to match the actual physical output of the country, not endlessly printing cash. History gives us harsh evidence of what happens when governments ignore that balance and print money to mask severe structural and supply constraints. The result is hyperinflation. Look at this historical photograph from Weimar Germany. The currency lost so much value that it became a physical burden. Citizens literally required heavy wicker baskets just to transport enough cash for daily transactions. This image from modern Venezuela shows how rapidly basic survival gets priced out of reach. Towering stacks of inflated currency are required to purchase a single minuscule bowl of rice. And this banknote from the Zimbabwean economic collapse represents the extreme end of the spectrum. The state was forced to print a $100 trillion denomination just to keep up with spiraling costs. When a government attempts to indefinitely expand its money supply without any regard for its actual productive credibility, the numbers on the paper lose all meaning. The currency destroys itself. However, when newly created credit is tied to actual productivity, the outcome is entirely different. Credit can be used correctly to finance long-term physical investments. If that capital is deployed to build new infrastructure, advance technology, and train a skilled workforce, the nation's physical capacity to produce expands alongside the money supply. This real-world growth absorbs the extra currency and prevents inflation. Returning to our opening scenario, receiving 10 unbacked lakhs does not give you a richer life. Without corresponding physical growth in the economy, you simply end up paying much more for the exact same standard of living. Because while a state can instantly create money out of thin air, real, tangible wealth always has to be produced.